My name is Glenn Hutchins, Vice Chair of the Economic Club, and I'd like to welcome you to the 508th meeting of the Economic Club of New York. We waited this long to have Brian Moynihan to join us. Economic Club of New York is the nation's leading nonpartisan forum for speeches on economic, social, and political issues. More than 1,000 prominent guests, including many presidents of the United States, have appeared, prime ministers, so on, have appeared before the club over the last century. Established a strong tradition of excellence, which I guarantee you continues today. I'd like to take a moment to recognize our members of the Centennial Society who are attending today. As I've said many times, the Economic Club of New York is the best bargain in New York City, but the Centennial Society members choose to make, in additional to their dues, capital gifts to support the club's activities. We very much appreciate their working to assure the financial soundness of the organization, help us to offer our wonderful, diverse programming. So thank you. We also have with us today students from the NYU Stern School of Business. Where are they? Somewhere around here? Maybe they're still taking final exams somewhere. Oh, okay, great. Bravo, welcome. Oh, here we go, over there. I'm sorry, I couldn't see you for the lights in my eyes, pardon me. Welcome, nice to have you with us. 2019 class of Economics Club Fellows, young up-and-coming business people in New York City who have got to get a chance to integrate with the club's activities. We're happy to have them with us. And as I say, it's my special pleasure this afternoon to introduce someone who I flatter myself to call my friend, Brian Moynihan, Chairman of the Board and CEO of the Bank of America. Brian leads a team of more than 200,000 employees dedicated to making financial lives better for people, companies of every size, and institutional investors across the country and around the world. I think the thing is very interesting under what has been accomplished for it as a workplace in the time period when we're thinking a lot about workplaces and diversity in our country. Bank of America is recognized as a top employer by both Working Mother magazine and the Military Times. That's actually quite an extraordinary accomplishment, Brian. You should be proud of it. It's listed on Fortune magazine's best workplaces for diversity, best workplaces for parents, best places to work for disability inclusion by the National Association of People with Disabilities. In 2018, Euromoney recognized Bank of America as the world's best bank and the world's best bank for diversity and inclusion as part of their annual awards for global excellence. That's a really extraordinary accomplishment. Well done. It also has been recognized with the Catalyst Award. Some of you are familiar with the Catalyst organization that supports development, empowerment, and advancement of women in companies all around the world. Brian also, in addition to his important work as the inside the bank, he's an active participant in the community around us, something that is also he serves as a role model for business leaders around the world. He's been involved with the World Economic Forum, the International Business Council, the Financial Services Forum, the Bank Policy Institute, the Business Roundtable, and the American Heart Association CEO Roundtable. He's also a member of the Federal Advisory Committee, the Federal Reserve Bank Board. I will tell you that being involved with the Fed myself, that's a very important activity, serves as an important interaction point between the financial services institutions and policymakers. He's a member of the Museum Council for the Smithsonian's very important Museum of African American History and Culture, member of Brown University Corporation's Board of Fellows, and of the Congressional Medal of Honor Foundation Board. He also has a day job, so that's a lot to do, Brian. Thank you for everything you do. The format today will begin with a few remarks from Brian, followed by a conversation in which we're fortunate to have fellow club member and another one of my friends, Maria Bartiromo, here to anchor and global markets editor. Boy, that's a big title, Maria, for Fox Business Network at Fox News Channel. She'll be doing the honors interviewing Brian today. Maria has received questions suggested by attending club members. He used the club's portal when registering to share topics they would like covered. I encourage you to do that in the future. We take those very seriously. As a reminder, this conversation is on the record and is being carried live. Brian, the podium is yours.
I want to first thank Glenn for the nice introduction, and you are my friend. You can, we share the Boston Celtics in common and a few other things, so we won't get into baseball. I want to thank the Economic Club for giving me a chance to share some time with you today. And we're going to break this up in two pieces. I was going to about 10 minutes introductory comments about something I believe is very important. And then Maria will ask me about the questions as Glenn described on what's going on in the economy, and also what we're doing in our company, driving responsible growth. We completed 2018, made $28 billion after tax. We made $7 billion plus in the first quarter. And I think, as Glenn referred to, we've done it the right way. And we've done it by having great customer results. And thanks to all of you in the audience, our customers and clients. And the team continues to deliver for you. And we continue to invest heavily in technology, talent, and capabilities. But before I want to get started here with Maria, I want to discuss a topic which has received a lot of discussion lately, and that is capitalism. And more precisely, debate about capitalism versus socialism versus progressivism, or debate of whether capitalism is right for America or for society. Oddly enough, when I was at the House hearing a few weeks ago with my peers, we were asked if we were capitalists. So here I am as the person who runs one of the largest profit-making companies in the world, whose job it is to help people live their financial lives and helping to connect in the world, which means to help them participate actively in the capitalist system. So of course I answered yes, but I was a little surprised about the question. But as I start this discussion, I do acknowledge the concerns that are out there. The concern around equal access to opportunity to participate in capitalism. The concern whether companies are sharing profits or paying people equitably. The concern and debate around priorities of capital return. Discussion of whether the issues of climate change are getting away from our society. And the concern of what will happen to today's workers as we continue the path of the fourth industrial revolution. The consistent discussion also of responsible impact or ESG investing. And last, the discussion about responsible self-governance by companies. These discussions are right in the center of the policy debates that are going on in legislatures and executive branches throughout the world. They're concerned for all of us here today. They're concerned for our clients, our communities, and our shareholders. And our teammates discuss these at the proverbial water cooler every day. But let me start with citing a few people who I've had the pleasure of having in-depth discussions about capitalism. I'll call them the killer bees today: Bono, Buffett, and Bloomberg. The three different people who all get to a similar spot: an entrepreneur, a rock star, and a legendary investor. Each has benefited greatly from the capitalist system, and they freely admit that. Each has outlined pluses and minuses, but all are committed to capitalism as a way forward. In 2012, Bono made an appearance that we hosted at Georgetown University. He told the students about capitalism and how it's done more for society than developmental or government aid. However, as he said recently, capitalism needs to be tamed. The following year, we hosted Warren Buffett at the same symposium at Georgetown for discussion. As only Warren could, he held the students completely spellbound. Young millennials who were thinking about their role in society, and Warren talking about what it meant to do all the things he'd done. And he explained to them carefully that capitalism is the system, the successful system in the world. It may leave some people behind, and therefore we have to have ways to deal with that, take care of that other side of capitalism, but we can't question capitalism. And recently, Michael Bloomberg wrote an editorial in the Boston Globe on occasion of his address at the Harvard Business School's commencement. He announced an annual conference regarding investing in the era of climate change. In that editorial that day, he again said simply what Mike can do better than anybody else: capitalism works. However, he also said that capitalists can't stay stuck in the past. And he said in the past, capitalists can't forget that progress in its own is an economic stimulus. In this conference, the starting will harness the power of the market to protect the environment. These wise leaders raised an important question: how do we drive capitalism ahead to solve society's concerns? So what I believe strongly here is that only these issues can be solved if the great companies represented in this room and other companies around the world are involved and in fact drive this. Capitalism is a system to solve the concerns, but it has to be done the right way. But first we have to agree, what are the concerns? What is the task we've been assigned? Well, Bank of America, you know that we've launched a new ad campaign that talks about how we approach our customers, our teammates, and our communities. We ask a simple question: what would you like the power to do? The world's answer to that question is summed up in what the world leaders agreed to in the Global Summit in 2015 at the UN, when they set forth the SDGs, or the Sustainable Development Goals. 17 areas that address equality of opportunity, access to clean water, renewable energy, affordable housing, and other priorities, all with specific goals to be met by society. 193 countries agreed that this was what society needed. So we do have the goals that are set, and one would assume that the world would desire us to make consistent, measurable progress on those goals every year. But let's deal with the fiscal reality of those goals. The SDGs are estimated to cost $6 trillion annually in investment capital. Loans, equity, in-kind contributions, charity, money in whatever form, but $6 trillion a year. Now, many in society have spoken that they believe charitable efforts can accomplish the task, but they simply cannot. Why? There just isn't enough money. Total charitable contributions worldwide last year are estimated to be about $800 billion. We as Americans made half of that, the generous history of America. But all $800 billion isn't close. Then other advocates say for the great universities and foundations, drain them all and give all the money away instantaneously to solve the world's problems. Well, that doesn't work either. Global nonprofit foundation assets are about $1.5 trillion. So if we emptied them all in 1 year, we'd have about a quarter of the demand, and what do we do for the next year? And other people say governments can solve this issue. The U.S. operating budget's probably the largest in the world at $4 trillion per year. If we took all that and put it towards the 6, we'd cover 2/3 of it. But no federal offices open, no post office, no Social Security, nothing. No debt payments, everything would have to go to it. And if you start to debt finance it, we already know the fiscal issues that we'd face quickly in that regard. So how do we drive it? Well, the private sector is the answer. But the private sector can't fall in the trap to try to accomplish progress with corporate charity alone also. And since 2010, our company has delivered $2 billion in charitable giving. That's a lot. But if the whole S&P 500 gave it the same rate, that still would fall far short. So what do we have to do? We, the private sector companies, have to align our ordinary business activities, the things we do every day, to help solve these challenges. For Bank of America, that means we have to bring our $2.4 trillion balance sheet to bear to the task. We have to bring our $53 billion expenses and how we spend them to the task. We have to bring our $245 billion in equity to the task. We have to bring the trillions of dollars a year we raise for you, our clients, to the task. And we have to bring the $2.8 trillion invested assets in our wealth management business to the task. That is how capitalism can solve these challenges. If all the companies align themselves to deliver on the relevant part of the SDGs, and we measure their success. Capitalism has the money, the creativity, and the expertise. And it's a lot of money. But now how does a company do it? How do you do it in your company? How do we do it in our company? First, we do it with our core operations. We will be carbon neutral by 2020. Second, we drive our charity and our philanthropy and our volunteering and our community development investing. Over the last 10 years, $45 billion lent to low and moderate income housing, predominantly in communities. Third, we do with our employment practices that Glenn referenced some. We employ teammates, 200,000 plus. We support their families, their economic growth, their development, providing funding for them to do many things outside work, including education for their kids, et cetera. We also have to have strong and progressive health and wellness benefits. Family leave of 16 weeks for everyone. Bereavement benefits. The minimum starting salary at Bank of America as of May of $35,000 a year for any employee, going to $40,000 in the next 24 months. We have to give our teammates the ability to reskill as the fourth industrial revolution takes hold. We have to hire those who need the help. 10,000 veterans in the last 5 years, 10,000 new teammates, which we're halfway through from low and moderate income neighborhoods. We have to then do it with our core client financing activities. For example, just on green bonds alone, we've underwritten $40 billion. That's not money we got. That's money that went to our clients to do the kinds of things that will push their environmental change, and that's very important. Then we have to help investors think about how they invest, whether it's opportunities, impact investing, blended finance, however they're going to finance the SDG transformation. In the end, we have to drive the whole business, the whole operations, the effort. But at the same time, we have to remember one thing. We have to produce the profit. We have to drive progress, and we have to produce good returns and great returns for our shareholders. We have to drive profit, and we have to invest in the future. We have to do both, otherwise, simply, I won't be here, because the next management team will be here to drive that profit. Companies have to conquer the genius of the and, as Jim Collins calls it. We have to produce great profit and deliver on our purpose. We have to produce great returns and answer the world's response to the question, what would they like the power to do? If private companies focus on delivering both through their individual business routines, operations, and practices, then we can channel the world's capital to the progress in the SDGs. But to ensure we make progress, we also need one other thing, a framework or a series of simple frameworks to measure success. And we have to agree that progress is progress to let the companies continue to work on it at a good pace. We need this so we can demonstrate that both we can generate returns and deliver progress, and we can reward the companies that can achieve both. Our expert research at Bank of America demonstrates that companies who don't follow these priorities are more risky and less predictable. In fact, if you didn't invest in the companies that didn't follow the ESG type of priorities in the last 5 years, you would have avoided 90% of the bankruptcies. So they're not yet proving that it's outperformance, but they are proving it's underperformance. These measurement systems will ensure capital flows towards companies that focus on addressing society's priorities and providing great returns to shareholders. In the end, this is how we tame capitalism, as Bono mentioned. This is how we deal with the fallout that Warren Buffett mentioned. And this is how capitalists make progress, as Mike Bloomberg mentioned. The genius of the and, the genius of capitalism. That's the best way forward. Thank you.
Capitalism, because it certainly has become a real debate, amazingly, by some capitalists. So great comments there. Hi, everybody. Great to see you, and happy to join you this afternoon. Brian, you talked a lot about capitalism versus socialism. I want to get your take on the broad economy for a bit before we go back to that, because I do want to get your sense in why you think younger people think maybe socialism is better than capitalism. But we could go back to that. We're seeing some signals recently that things may slow down. We got a GDP of 3.1% in the first quarter. We know just a week and a half ago, but we've seen Purchasing Managers Index come down, the global purchasing managers showing that manufacturing may be coming in. How do you see the broad economy right now?
Well, I think let me start by sort of the debate that's been going on since last fall, which is the debate between what it will feel like to go through a slowdown that levels off, 1.5–2%, versus a line that just keeps going down. And that's the debate that goes on every day. And some days some people win, some days the other people win. And so, but what do we see today? So when we think about Bank of America, we have our experts we have one of the best research platforms in the world, Candace Browning-Platt, that runs it, and the team does a fantastic job. Their prediction for 2019 GDP growth in the United States, they just moved from 2.5 down to 2.4. But they've followed this travel, 2.6, 2.2, 2.5, 2.4, all across the last 6 months. And that's largely bouncing around some of the topics we went into in the belief of whether trade issues will solve or whatever. And on a worldwide basis, it's low threes. So they believe that the economy is still growing. What we then have, the different insight, is what our customers are doing. And if you think about the U.S. economy, it's 2/3 consumers. The size of that economy is basically equivalent to China's economy. And so when we think about what's going to happen in the economy, I focus a lot on what consumers are doing. And in Bank of America, so far this year through May, we've had $1 trillion in payments made by consumers, a check written, a credit and debit card payment, cash on the ATM, ACH, wires. That is up 5% plus from last year. 17–18, it was 8.5, and it was like 4 to 5 the year before that. So what you saw is the economy grew faster, it went up to 8, and now it's come back down. But it's very strong, and it's actually picked up during the year a little bit. And so we feel very good about the consumer. And when you talk to our business clients, they're borrowing money, they're making things, they're worried about all the things that we're all worried about in this room, and the ebbs and flows, and what you talk about every morning in terms of trade and whether it resolve and those types of things. They're worried about getting employees. But overall, they're making money, and they're happy, and they're borrowing at the highest rate on the middle market lines of credit that they borrowed at in 10, 15 years. That means they're putting the money to work somehow. They've stored a lot of cash, which means they have more money to invest. And I think it's just going to take a little bit of clearance away some of these potential bumps that will then kick them back in.
Yeah, it's interesting that you see an economy that is still strong despite all of the uncertainty around trade and tariffs. So that's really what I wanted to get your take on. Because CapEx numbers is something we look at very closely in terms of an indication for the economy. And while CapEx was up about a year ago, I believe the Journal reported it was up 20%, now it's up about 3%. Are you seeing uncertainty set in corporate America as a result of the uncertainty around trade and tariffs?
So we'd have different numbers, but the same trend, which is that last year you saw about twice the rate of this year, a little higher this year than the numbers you gave. But it is slowing down, again, because there was a rush to get things done. You got to think about late 17, nobody believed tax reform could get done. There had been a plan on the place for the entire administration in the two administrations of Obama that was agreed to tax reform, never got through the group of six or gangs, whatever they called themselves and everything. And all of a sudden it happened. And so the enthusiasm out of that took off. And so people went and spent the money and did the things. Then, of course, you only need to buy so much. There's a slowdown on the other side of it, and that's what we're feeling. But it's still consistent with a healthy economy, but albeit an economy probably 2%-ish versus 3%. And that's what's playing out. So we feel, as you look at the businesses and even capital spending and stuff, it is slowing down. It was predicted to slow down. That was what everybody said early 18 about 19 in their second year. It was going to slow down. The question is, will it slow down, or will it slow down and keep going on a line? And that's the debate.
And, it's interesting, we are in year 10 of an economic expansion, about to break the record of the longest economic expansion.
By definition, we have to break it now, unless they revise backwards. We're in the quarter that would break it. So.
Exactly, and people are saying, well, maybe it's just the age of this expansion that could turn it around. I don't know, but so far it sounds like you're not seeing all that much change, even though, yes, things have come in a bit. You're not seeing all that much change from the consumer or business as a result of this uncertainty.
Access to credit is good.
You're expecting it, but?
Yeah. Access to credit is good. The people's wages are growing. Unemployment is at levels that are unprecedented, 50, 60 years. So when we think about all the stuff going on in society, when was the last time that new claims for unemployment ran 200,000, raw number? 1968, 1969.
Wow.
When was the last time? Society was in pretty rough shape then. You think about from 1968, 9 through 72, 3, 4, think about what happened. Nixon, Vietnam was raging, Kent State, Martin Luther King, Bobby Kennedy, the DNC, think about all that went on. And then ultimately a oil shock and a oil war and then a shock. You think about all that. And yet, here we are on the other side. You know how many people were employed in 1968 in America? 70 million. Now how many people are employed today? 150 million. So the ingenuity of that capitalist engine we're talking about solved the problem. By the way, technology was going to take away all the jobs if you were around in 68 and stuff like that, computers and stuff like that.
Yeah.
We made it through. Now, how we're going to make it through, I don't know. But I think people will get too worried about some of this stuff. When you really think about it long term, it's a very powerful engine this economy we have is, and it'll ebb and flow, and that's the point. 10 years in, everybody's saying it's got to flow. When does it, or whatever the right analogy is. You're saying, why does it have to? And that's going to be the interesting debate every quarter now, and that's why you're seeing this boom, boom, boom.
We have to talk about interest rates and the Federal Reserve, of course. I want to get your take there. But you just said something that I want to stay on for a moment, and that is about your employees and wages. You made the conscious decision to actually raise wages at B of A. You've gone from, you're now at $17, and it's going up to $20. Tell me about this. What was behind this decision? Because you have been also very prudent and conservative in terms of your expenses, and yet you're raising wages in a significant way.
Yeah, what the team's done a great job of is figure out how to transform the company. Well, a lot of you were thinking about all the stuff you talk about us in 2012, 13, 14 that was going on. Underneath it, the team was doing a fabulous job. So we had 280,000 people when I became CEO. We have 205,000. The company's bigger. That was by applying technology, improving process, and changing stuff. What that's also given us the ability to do is go from $90,000 average comp in our company to $150 in that time frame. For people in the lower 2 quintiles of wages, they've had, if they were since 2010, every year, 6 to 7% wage and salary increase every single year. And at the same time, we dropped for the people paid, we dropped the healthcare cost contribution in half and have not raised it since 2011. All that was to have teammates that felt better and better about the company and could do a better and better job for our customers, and to keep the turnover against this 3.5% unemployment, 3.6%. It's hard.
Yeah,
and so we brought the turnover down by half, but it's still high. And so we need very talented people, and we did it. And then the last thing we did is we also made that we, as a company, have profit margin, ability to earn money, and ability to do business the right way, that we would not let employees would always be way above sort of the minimum poverty for family, even if they're an individual. And so
above minimum wage.
We said way above minimum wage, but way above that. So we set a 25% buffer that. Now we're running 50%. That was a conscious decision that we didn't believe our our teammates should ever be in a position that they don't earn significantly more than the prevailing standard of living in a.
No, that was a big deal, and you did it right before you were testifying in front of Maxine Waters' Financial Services Committee, so that was quite clever of you as well.
It was a natural progression. We crossed 15 in 2017, which was a great debate, and I think I talked to you about that in Davos that year.
Yes.
And we were going to cross 16 and change, but just for the merit. And I said, let's end the debate and go to 20, which is 40-some thousand bucks a year. So, I said, and let's just end it and let people know the course. And again, so our teammates will feel good. Our rest of our teammates feel good about it. But importantly, if we can shut down the turnover a little bit, and it's the lowest it's ever been. But if we can get a couple hundred basis points out of that turnover rate, that's a big deal.
Are you getting the feeling that we could be walking into a tougher regulatory environment for the banks? I mean, obviously, this administration has lowered regulations, but the big banks haven't really felt it. I mean, it's been the small and mid-cap companies that have really gotten the relief on the regulatory side. Where are you on that issue? Are we walking into a period with the Democrats in control in the Congress, ready to put further pressure on you as a large SIFI bank, or do you feel the opposite given Trump's deregulatory environment?
Well, I think the key was to get in place between capital, liquidity, resolution, ability to resolve a major company, get everybody under the tent, change the activity scope. And that was all put in place, but they're still fine-tuning that. And if we could just stop and make sure we got that right. And so what we talk a lot about is, if you are 15% of the FDIC insured deposits, and whenever there's a failure, basically the fund pays for it, and then we build the fund back up. We have a higher interest in making sure people are safe and sound than anybody else. And so I want capital and liquidity and asset quality and all the things. The problem is when you swing the pendulum too far, you got to make sure you swing it back. And so I think we're advocating you get the pendulum a little bit back to middle, but not change the scheme. Stress testing is very strong, and we'll find out this year's test here in a bit. And what that says is these banks meaning not just the big SIFI, but everybody, shouldn't be the problem. And by putting more stuff under the tent, and there's been stuff creeping out, you shouldn't have the same problem, because people sort of rewrite history from the back, from where we are today, but most of the people who failed weren't in the tent. And the issue was what Chairman Bernanke and others were doing at the time, is they had to make up, I shouldn't say make up, they had to figure out ways to solve problems that weren't really the banking industry's regulatory framework. So we fixed a lot of that, and that's good. But we got to be careful, because there's a real cost-benefit analysis that's here, which is, if the simple numbers, we have 10% capital requirements. 3% of that is for the SIFI buffer, and it's only 2.5. Let's just make it 3 for the math easier. 3% of that's for the SIFI buffer, 7% is for the base capital. So a regional has 7, we have 10. If you think about that, it doesn't sound like a lot. You say, oh, it's 3%. That difference is $50 billion in capital we can take no risk on. So if you said, let's say that 2 versus 3%, so you take 100 basis points, we can make $100 billion more loans that we can't make today. So the calibration's the key, and that's what we're looking for. So, and we believe, by the way, that our POC should not be visited on other people's houses, that you need to have less regulation for smaller banks. We were clear on that, the SIFIs were, and because if they fail, they don't create the same problems. We'll clean them up and go on.
Let me go to another gap, which a lot of people are talking about, and that is the gap in interest rates. We're seeing the 10-year drop like a rock down to it broke 2.07% actually. The yield curve has now inverted, where you've got the 10-year actually lower than the 3-month at 2.3%. Important conference going on in Chicago in terms of Fed policy. Jay Powell this morning said he's ready to act. What does the inversion tell you, for starters? Is this indicating that a recession is on the horizon?
There's a common view that there's a correlation between inverted yield curves and recession, and it proves to be true a number of times. It also proves not to be true. And so I think you've really got to focus on the real underlying economic data and what you're seeing come out. And so business confidence is strong, not as strong as it was, but strong. Consumer confidence is strong, not as strong as it was at its highest point. Spending, et cetera. So I think you got to concentrate on that. I think the thing about the yield curve, which is different this time, so I read an article the other day that said this is like 2006, and so get ready. The German 10-year rate, I think in 2006 at the same time, was 3% positive. It's now 30 basis points negative. So the question is how much the capital flows around the world are creating, the massive rally in the American bond market, because we're positive, and so you got one side that, a group of people say it's a recession indicator and they can prove that out. You got another side proving no, it has nothing to do with it, and there's other factors at bay, and they can prove that out. What I try to do is avoid the debate other than to watch people argue with each other, which is kind of fun, and really just sit there and say, what do we see in day-to-day activity? And the activity of the consumer in America has gotten incrementally stronger during the year. And so unless people don't have jobs and aren't getting paid more, I think what will slow them down will be that, and we don't see that. And by the way, when you talk to our clients, I've asked a question here, the number one issue for most of the people here, I can't get enough employees. And so they're all hiring, they're all trying to, and replacing people. Last year we hired 27,000 people in our company. 27,000 people. Now, the people that left us went someplace, they have jobs. Some retired, but most of them left and had jobs. They left, it was, and so we had 27,000
And you want to see that. You want to see that kind of, that tells you that the economy is strong.
Yeah, they're healthy, 200,000 jobs, 197,000 jobs. I mean, so I wouldn't, I think people are, overlooking at that market indicator, but I can fully understand why, and it's a trading question and people making money, but the real question is what's going to go on the underlying data, and I think Chair Powell this morning in many cases has been, and a whole group of people have been clear that if they need to help the economy, they will, but they're not going to help it unless they need to, and that's what being in the neutral range means. So, until they got there, they've gotten the neutral range, and that now it's really going to be, as one of the former chairs told me, it's like climbing a mountain. It's a handhold the next meeting, and then a handhold. Everybody thinks there's a pattern to it, but it's really literally just where's the next place to put my hand so I can hold up, and they're trying to figure that out.
So what you're saying is, number one, the backdrop still feels very strong to you. The consumer, when you look at what the consumer is doing in terms of spending habits, it remains quite robust. And on the other hand, what you're saying is, yeah, rates have dropped and treasuries have gone up, but that's because there aren't a lot of alternatives across the world.
And now the market has, our economist, Michelle Meyer, put out this morning, I think 3 cuts between now and next year end or something like that. We'll see if that holds. If these trade things fall into place and you see some calm down, it'll be interesting to see how fast that comes back out of the market. By the way, it was in the market, came out of the market, it was in the market, literally ebbing and flowing based on the debate. And so it's not really there, I think, for as fundamental reasons yet. Now, we'll see the data, and if data starts getting weaker, then I think it's more fundamental.
But what a change in conversation, though. A year ago, we were talking about the Federal Reserve raising rates 3 times, winding down the balance sheet so that it could get the balance sheet way down from the $4+ trillion. And now we're talking about a cut in interest rates. Is that largely because the Federal Reserve wants to get to its inflation target? Maybe that's it.
When you get to this debate about monetary policy, I've always said my debating with the Fed about how they're going to set monetary policy is not a high-value task for me because I'm not sure. They are concerned that the inflation has stayed in the ranges it stayed. They've been clear of that. I don't think you don't need to have some divine whisperer here. You could just go read the minutes. They're worried that inflation's not, they worry that wage growth is not as strong as they'd expect at this point in the cycle. Does the Phillips curve work? What's happening is the Phillips curve is getting back in sync now as the wages have been rising at 3% as opposed to 2%. We see much more wage inflation. I'm sure the business owners and operators here do too. The idea that wages are only growing at 3%, I'd like to find one cohort in our company that's close to that. I'd like to. It just isn't true. And so I think they're debating the inflation issue. But it is interesting that it wasn't last year. It was, last November where we were debating
Thank you.
whether they're going to raise rates and stuff. And it was predicted, if you look at,
That's right.
our financial plans that were developed, late last year, it had rate increases this year in them. And by the way, we don't make it up. We just take the market's blue chip consensus. So you don't have to go back that far. So what's happened in 6 months? Trade war. Brexit isn't getting solved. People are worried about the impact on China slowing down, the impact on Europe, which is much more into that. And then you're worried about even Brazil, which was come along a little bit. So the world estimates have come down, and Europe's estimates have come down. And so, it's been 6 months, and now half empty says, oh my gosh, people are revising down. Half full is, it's only been 6 months. So what would be the condition to put us back in a different mode? 6 months' time, I don't think in November in October, November, we thought we were in some crazy environment that was over, it wasn't real estate prices growing at 15% a year. It was real estate prices growing 3% a year. So all we could do is sort of get people back into that mode, get the thought process back in that mode, and that's going to come down to, I think, solving some of these core issues, which the Mexico government's up here today trying to figure out the situation. I was down there last Thursday and Friday. It was an interesting time to be there. The president, as he's announced, spoke at an event we had down there for our teammates from around the world somewhere before the situation changed for him that afternoon, and talking to his cabinet and stuff. They need to solve this. They're trying to figure out a solution, and they're up here doing it right now.
Do you feel like it's actually worsening the trade worries because now the president is looking at Mexico, or do you feel that this is just bluster? The president is playing poker in a sense. You're right. Mexico officials in Washington this week meeting with Secretary Pompeo. He's got to get USMCA passed, and you've got this political dysfunction in Washington where you're not seeing a lot get done because the two sides hate each other so much. If they don't get USMCA passed, does that blow what you're talking about? Does that disrupt this strength in the economy?
Right. So I think the economists have already, just because of the delay and the perceived delay in resolution in China, because even going to a few weeks ago, when the negotiations broke down in Hawaii, everybody said, "Oh, by the G20," and now it's a little more debate. We'll see what happens. But
right.
And then the USMCA, Canada and Mexico started the process. So, and then the change. So I think the clarity around that would add back. What would it add back? I think until it was past tense, I think it's going to be harder to add it back. So they went from 2.6, which assumed it was all going to get done, and like last fall, to 2.2 when it wasn't going to get done. Back up to about 2.5, this is GDP for 19 in the U.S., and then back down to 2.4. And so I think what you're seeing is that it's delay now. If it stopped cold and it was clear nothing was going to get done, I think it would come down further. I still don't think the U.S. economy, they don't believe by what they published this morning the U.S. economy would go into recession.
And you don't see it when you see it raw data. You're seeing raw data about the consumer.
We won't see it till it happens, but right now you don't see the impacts. You see some companies are starting to feel the effect of tariffs from taking equipment out of China. It's gotten expensive. So, an example of a client today that got relayed to me was, they're going to buy 2 pieces of equipment, they bought 1, and that level of uncertainty just isn't healthy. When you discount future cash flows, which is what every business assessment does, anything that puts a variability around those cash flows. You as a senior executive are going to ask people, what's the range of outcomes here? And if that range gets wider, you're going to be more reluctant to do it. And that's what you're feeling right now, is people are saying, wait a second, if this trade goes really wrong, what happens to me? And do I need to buckle down? Do I need to hoard some cash? Do I need to slow down a little bit? So I think the relief valve might be more than we expect. That was 3% in the first quarter when a lot of this was going on. And there's some technical reasons for that and happy stuff. But so I think it would be better. I think it would impact it. But I think they took part of that into consideration today, especially the delay in the way our experts looked at it today. They were clear. They said this is starting to reflect a trade disruption.
Actually, I was surprised that the GDP wasn't revised downward more, from 3.2 to 3.1 in the most recent reading. You just mentioned real estate. Yeah. What can you tell us about housing right now? Because mortgage rates have also come down, and I'm wondering if that has been a bit of a spark in an area that we were seeing some signs of weakness within real estate.
Yeah, and so this is, again, will be a glass half full, half empty. Real estate prices are going up about 3% year over year, 3 to 4%. Almost every city is seeing, rises. In the hottest cities faster.
Every city, wow.
Yeah, 20 cities are up 3%, so that's the top 20 cities. And so, the long-term trend, if you looked at the curve coming up to 4, 5, 6, and then saw it shoot up and then come back down and get back on. It's basically on the same trend at 3%. It's just it found some ways way up and way down. This is healthy. So 1 million and change units. The population's only growing at 0.5%. Household formation is about 1 million a year. 1 million units is healthy. Car sales at 16 million versus 17 million. People can wring their hands, but 16 million is higher than all but a couple years in the history, other than the last 4 or 5. There's 40 million used cars sold a year. So the underlying activity, if people are employed at the 3.5, it's going to be fine. It should. We don't want housing to go up to 6, 7, 8% a year. Right. That's what we had, and that's fueled by, it's the biggest leverage bet all Americans can make. 5% down, 95% credit. You can't make that. You buy securities, it's 50-50 at most. You do a lot of things, it's less. So the idea, we don't want that. So 3% is fine. Now, when it gets out ahead of that, that's usually due to, San Francisco and places, Boston, places like that. They're just hot for jobs, and that'll settle back down. And there's housing shortages in those environments. That's a different question. But, so housing is very constructive and probably has more room to run, honestly. But the thing that we have to forget, we think about trade, but we also have to solve immigration, because at the end of the day, the population of the United States, in those statistics I gave you, went from 200 million to 300 million people. Workers went from 70 to 150. A big chunk of that was women participation changed dramatically from the late 60s to now. We need people from outside the United States. It takes 21 years to create a 21-year-old. So population growth rates just don't. I'm one of 8 kids, so I can. Population growth rates don't change fast. And if you study the economies that struggle, China, Russia, places where population declines, you're always fighting a shrinking pie, and we need population growth. It's going to come, so we have to have some resolution of that, because we need the people, I think, to help fuel the economy. But housing in that regard is actually very healthy right now, and I believe personally has some room to run. I think mortgage rates being down always help that. And a lot of people have very low rates. The refinancing, people that really get something out of refinance is pretty low, because you got to remember that there's been a long 10 years of rates being in a fairly low environment. But it does allow a little more purchase power on the buy, and then the new millennials coming in who have been slower to buy, largely because they're urban. If you think about where they're living, you don't want to, you're not going to buy a house, a co-op in New York City if you're coming to work for one of the companies. They never did. It's just more of them are coming to the cities to work now. So that's part of the change. That'll change over time, I think.
So is there anything that you're seeing in the credit cycle that has caused you to increase your provisions? I mean, how are you competing with some of these easier lenders out there who perhaps don't have the standards? Are you lowering standards in any way right now?
Yeah, we aren't lowering standards, because we tried that and it didn't work so well. So, and we bought a couple of companies that had really done it, and it didn't work so well. And so we have this idea of responsible growth. And so if you look at the stress test, we have lower aggregate charge-offs and everything. We're running the company that way, which means we'll fare better in a recession, and we'll be able to keep growing the company and driving it. That's kind of a basic philosophy. And I also think some of the products, as we observed in the past tense, were not the right products for consumers. But in terms of credit quality overall in the United States on the consumer side, credit card delinquencies, charge-offs in very good shape. Always the issue is more in the subprime category. Auto, very good shape overall. People brought back the credit lines. The real debate right now is about the leveraged finance markets. It's largely financed outside the banking system's balance sheet, to be clear. And that's in the hands of investors who will see marks if they go the wrong way. There's a concern whether that can, and Chair Powell talked about it, because he 2 weeks ago or something. It's not clear how big an impact it has as $2 trillion asset class. It's in what you call NAV holders. In other words, people whose liabilities float with their assets, their duration's more matched than a bank would be and stuff. So people don't feel, but I think we should worry about that. And then the impact of corporate credit. That's really the thing. We don't see anything yet, because the economy is good and companies are making money, but we think at the margin, if society writ large is going to face this recession, would feel more like the 99-2000 was driven more on the commercial side than on the consumer side, because the consumer, you've had 12 years of pretty strong underwriting on the consumer side, and that has driven the consumer to be in pretty good shape.
Yeah, because Bank of America, the legacy business was always strong. You go back to the crisis in 2006, 2007, going into 2008, and it was the companies that you acquired that were really having issues, like a Countrywide Financial or, well, at that time, Merrill Lynch. So
you're gonna ruin my lunch before I eat it?
No, I just want to know where you are seeing the potential fallout in terms of the next crisis. What do you worry about that we ought to be worried about in terms of where to look, which could have the weak spots, so that we're not blindsided like we were?
I think the issue that's there that is in the leveraged finance. Have the terms gotten too favorable to the borrower, numbers of EBITDA multiples, covenants, things like that. It's just a smaller asset class, and it's a smaller amount, and that's good for society writ large. But it'll be ugly for those companies, and ugly if the economy slows down and they can't carry the debt and they have to be restructured, and there'll be the usual carnage that goes on. And then there's a debate about people who are barely investment grade and what happens, who've leveraged up, and what happens if they go into non-investment grade. But that's, people are watching that, people are thinking about that, and frankly, the operators of those companies are trying to figure out how to deleverage. If you remember back in the crisis, the commercial real estate, they're the walls of refinancing that we talk about. The walls in this business are a little more spread out, and people are trying to push them out, which then gives you time.
You've been the leader in terms of digitization and moving the company toward new technologies. Talk to us about the products that are most popular, that are most effective, and everybody wants to know, what does this mean for workers in terms of replacing so much with technology? Tell us how you use tech and where it's most prevalent at the bank.
So there's probably 4 or 5 trends in technology that everybody has to, every business has to become expertised in and really understand how they're going to affect their customer base and the change. One is voice recognition. Another is data storage retrieval. The third is networks, speed, efficacy, latency, and all that stuff. The fourth is machine learning, artificial intelligence. The fifth is robotics. Now, in different industries, robotics will have something different, but in our industry, it's the ability to prepare information and do it all mechanically. Other industries, it's literally picking a raspberry, if you saw the article the other day. And so if you think about those 5 things at Bank of America, what we've been able to do is to apply more and more technology and digitization, taking out paper, taking out process, and having it travel digitally, having customers. So about 50% of the customers plus are getting digital statements and things. So you've applied that across all the businesses, and that's allowed us to really go from 288,000 people to 205,000 people with a bigger company in terms of more customer activity. Customer activity, payments and stuff will grow 5%, as I said, or 9% in this one, and you're doing it with the same amount of people year over year. Trading volumes go up every year, and we're doing it with the same amount of people. That's by applying technology. Now, let me give you a few specific examples. Erica, which is if you open your Bank of America mobile app, which all of you should have, and you talk to Erica, you can say to Erica, find all my recurring payments. Now, you're going to say that. You could be in a room that has background noise. You could have a connection that's, in where I live at home, that the cell service doesn't work that well, so it's choppy. You could have all these things. But Eric will come back and tell you all your recurring payments. Now think about, it's a combination of all the technology. First, voice recognition. We had to go out and create a new language for financial services. So we have 7 million people on this now, 50 million customer interactions. But we had to create a new language. Why did you have to create a new language? The phrase, what's my balance? If you ask a typical voice recognition, could send you to a yoga class. Okay.
That's cute.
And so you had to have a financial, so we built that. Then we had to then have there's 110 systems that go over behind the mobile platform that you're finding information from. So you think of all the accounts, all the entries, and all the systems. And you're not going to wait 10 minutes for an answer. So you had to have an ability to do the artificial intelligence and find it. Then you have to be able to transmit to it. And I always said about Erica, I said, it's nice in a quiet room, but what if somebody's driving in a car at 60, 70 miles an hour, or 60 miles an hour? Can you hear, will the thing be able to done? And we've been able to do that with that pace of network, because the networks have picked up. And then what it does is it saves you a lot of time, because at the end of the day, if you're worried about cutting off the gym membership you haven't gone to in 6 months and stuff, you can scroll through and figure it out and call the people and they won't answer the phone or something. Or you can just say, Erica, what are my recurring payments? And they'll tell you, boom, right there. And so that's a massive convenience to the customer. And so what does it really do? There's a thing called a routing number on your check. And looking at the age of the crowd, they probably know what a routing number is because they had wrote checks and knew it was on the bottom of every check. There's a different cohort of age that has no idea. And so we get 6 million calls a year asking, what's my routing number? So now if you've ever asked that question, Erica comes up and says, you need to know your routing number. And that cuts off hundreds of thousands of calls. Now that means somebody isn't doing not a high value task to answer the phone and tell it. So that's how you do it. Now you go to the commercial side, you have the same things. We have mobile. We have 27.5 million mobile customers as of last Friday. We have 37 digital customers. On the commercial side, we have about 500,000 commercial customers of fully on Cash Pro. One of them sent $1 billion payment on a mobile device last year.
Wow. And
you'd say, holy crap. But at the end of the day, it's just as secure. It might not be what what you would do, but it's just as secure, and it's pretty fantastic.
Real quick before we end, bottom line.
But we got to retrain all the people. That's one of the things.
Well,
so
that's important.
We have 40,000 people go through Academy every year, whether it's in tech and ops or whether it's in technology, pure operations or consumer, to keep retraining for the jobs of the future. And to me, go to my earlier discussion, that is something you can do in your own company. How do you retrain your workers so that they can make the transition and have a full career, knowing that activity A, activity B, activity C, activity D may go away? So how do we have people who are in audit that we can now do automated robotics come over to some other business? That is the duty of companies and CEOs and executives in companies. And if we do that, we can deal with the fourth industrial revolution. That's the point I'm trying to make.
This is important because that's what worries people, obviously, that their jobs are going to go away. Where does the growth come from at B of A? I mean, you're not a celebrity CEO. You're unassuming, low-key. You're grinding out growth. Seriously, I mean, you're grinding out growth here, and you've done a great job since taking over the bank. Congratulations. But where do you see growth coming specifically from the company? Let's call it the next 5 years.
We have lots of markets in the U.S. that we haven't been in traditionally, and we're opening up in whether it's Denver, Salt Lake City, Minneapolis, et cetera. We have lots of markets we're underpenetrated. So our market share in Los Angeles is 1/2 our market share in Washington, D.C. area in wealth management, so we got a lot of work to do there. Then we have trillions of dollars of assets and deposits and loans that are with other companies that our clients have a relationship with us and don't have it. And likewise in the commercial business, we're growing fast, but we have low double-digit market shares in middle market investment banking. We have a relationship with all those companies. We should own that space. And so all that's just hard work. And so it'll come around wealth management, it'll come around applying technology, but it'll come around good old-fashioned business, the 200,000 teammates going out and helping the clients solve their problems. And the consistency applying more and more teammates to it.
You keep lending, and those lending numbers go up, and you keep gathering assets in terms of AUM for wealth management. Do you want to get to a place where some of your competitors are in terms of dividend payouts? Some of the banks are paying 35 to 40% of earnings out in dividends. What are you, 21%?
We'll keep pushing it up. Our earnings are growing faster than other people's. That's one of the reasons why we're a little behind. So you can take that for what you want. But we believe the stock is so cheap. So we'll spend $6.25 billion buying stock this quarter, and we'd rather take the share count down because those companies that we bought created the dilution that we got to get out of the system. 12 billion shares, nearly at the peak 11.7, down to now 9.6, and coming down about 150 or so a quarter at least, maybe 200 million a quarter. And we'll keep raising the dividend. It went from a penny, nickel, 7.5, 12, 15. We'll keep going up. But on the other hand, as a person who owns net worth is in the stock, and the job is to have the people who want to own the company long term own more of it every year.
All right, we will leave it there. The final question, Brian, because I know this audience wants to know your gut. Will the Fed cut rates this year? What does your gut tell you? Don't tell me what your economist says.
I don't think they will.
You don't think they will?
Unless something goes really wrong in a trade, I think the economy is stronger than people think. And that's personal belief, so you can take that with a grain of salt. But I'm telling you that unless something goes really wrong and confidence breaks and unemployment breaks, this economy is going to move along in the 2% plus growth rate, and they're raising rates when we're at this growth rate.
Brian, thank you.
Okay.
Brian,
thank you, guys. Okay, give me 1 second. Well done. Thanks.
Sorry about that.
That's good. Thank you. Maria, Brian may not be a celebrity CEO, though he is in some households, but I doubt a celebrity CEO could make routing numbers seem so interesting. Thank you very much, guys. That was really wonderful presentation this morning. Before we close, I want to report that we have a couple more prominent speakers as we close out our season on June 19 at lunch. We'll have General David Petraeus, who, as you know, in addition to being a former director of the Central Intelligence Agency, was also a commander of troops in both Iraq and Afghanistan and at Central Command. So it should be very interesting. After that, June 24th, final event of our season, will be David Malpass, who minor distinction is that he's World Bank president. Major distinction was he was a former member of the Economics Club of New York. So that's it for the day. Thank you all for joining us. Enjoy your lunch.